Introduction. When you are in the stock market, day trading, forex, or new to cryptocurrency, you will hear a lot of trading terms that may sound unfamiliar. FOMO, ROI, ETH, HODL. What do these all mean? Trading and investment have their own language, and it can be daunting to learn all these new terms. However, they can be quite useful if you want to keep up what going on in the financial market. In this article, we are compiled some of the most important trading terms you should know if you are trading cryptocurrency. Number 1, fear, uncertainty and doubt. FUD. While not exclusively a trading term, FUD is often used in the context of the financial markets. FUD is a strategy that aims to discredit a particular company, product, or project by spreading misinformation about it. The aim is to instill fear and gain an advantage somehow. This can be a competitive or tactical advantage or profiting off a stock price decline caused by the potentially damaging news. As you expect, FUD is quite common in the cryptocurrency space. In many cases, investors may enter a short position in an asset, then releasing potentially harmful or misleading news when the position has been established. This way, large profits can be made by short selling or buying put options. They may also position themselves with over-the-counter OTC deals beforehand. In many cases, the information turns out to be false or at the very least misleading. In some cases, however, it turns out to be true. It's always good to try to consider all sides of the argument. It can be helpful to think about what incentives people can have by publicly sharing certain options. Second one, FOMO, fear of missing out. FOMO is the emotion that investors feel when they flock to buy an asset in fear of missing out on the profit opportunity. As there are heavy emotions involved, FOMO by a large number of people can lead to parabolic price movements. Investors who moving from asset to asset in a game of musical chairs can often signal the later stages of a bull market. If you read our technical analysis TA mistakes article, you know that extreme market condition can change the usual rule of the market when emotions are rampant. Many investors may jump into position out of FOMO. This can lead to extended move in the both direction and may trap many traders who try to counter trade the crowd. FOMO is also commonly used when designing social media apps. Have you ever wondered why it's usually more difficult to view posts on social media timelines in strictly chronological order? This is also related to FOMO. If users were able to check all the posts since their last login, they are having feeling that they are seeing all the latest posts. By deliberately mixing older and newer posts of the timeline, social media platform aim to instill FOMO in users. This made the users keep checking back again and again in fear that they are missing out on something important. Third one is HODL. HODL is a term that derived from a misspelling of hold. It's basically the cryptocurrency equivalent to the buy and hold strategy. HODL originally appeared in a now famous post on the Bitcoin Talk forum in 2030. The term was a spelling mistake in the time I am hodling. The hodling refers to holding on to investment despite price drops. It also commonly used in the context of investors, hodlers, who admittedly aren't good at short-term trading but want to get price exposure to cryptocurrency. It may also be used for the investor who have high conviction in a particular coin and intend to hold on their investment for a longer period. The hodling strategy is similar to the buy and hold investment strategy coming from the traditional markets. Buy and hold. Investors try to find undervalued assets and hold on to them for a long time. Many investors adopt this strategy for Bitcoin. If you read our dollar cost averaging DCA article, you know that this would have been a highly profitable strategy for Bitcoin. If you are bought just $10 of BTC every week for the last 5 years, you did up more than 7 times your original investment. BUIDL. is a derivative term of HODL. It usually describes participants as the cryptocurrency industry who continue to build regardless of price fluctuation. The main idea is that true believers of the crypto industry keep building the ecosystem regardlessly of brutal bear markets. In this sense, builders genuinely care about what blockchain and cryptocurrencies can bring to the world, and they are actively working towards this goal. Budil is a mindset that aims to explain how cryptocurrencies aren't just about speculation, how about bringing this technology to the masses. It acts as a reminder to keep our heads down and keep building in the infrastructure that may very small several billions of peoples in the future. In addition, builders understand that the team that keep building with a long-term mindset will likely do well over the long run. Meme uploaded by Pisunasi. It incorporates Binance CEO Chang Chao CZ saying funds are safe during unscheduled platform maintenance. The video went viral within the cryptocurrency sphere. In response, Binance has established the Secure Asset Fund for Users (SAFU), an emergency insurance fund that funded by 10% of trading fee. These funds are stored in a separate cold wallet. The idea is that the SAFU may cover the loss of user funds in extreme cases, offering an additional blanket of protection of Binance users. This is why you might often hear the phrase funds are SAFU. Return of investment (ROI). Return of investment is a way to measure an investment performance, measure that returns of an investment related to the original cost. It's also a convenient way to compare the performance of different investments. Here, how you calculate ROI? You take the current value of the investment and subtract the original cost of the investment. Then you divide that number by the original cost. ROI currently value original cost by original cost. Let's say you bought Bitcoin at $6,000. The current market price of Bitcoin is now 8,000. ROI is equal to 8,000 minus 6,000 by 6,000. ROI is equal to 0.33. This means that you are 33% up from your original investment. It also worth taking into account the fees that you have to pay to get a more accurate picture. Raw numbers are in the bold picture. However, when comparing investment, other factors are also at play. What are the risks? What is the time horizon? How liquid is the asset? Can slippage affect your purchase price? ROI isn't the ultimate metric by itself, but it's a useful tool to measure your investment performance. All-time high (ATH). We probably don't have to explain this one, do we? The all-time high is the highest recorded price of an asset. For example, the eighth of Bitcoin during in 2070 bull market was 90,798.686 USDT on the BTC USDT pair on the Binance. This means that this was the highest price that Bitcoin was traded for on this market price. Compelling aspects of an asset reaching all-time high is the idea that almost everyone who ever bought is in profit. If an asset has been in a prolonged bear market, many traders holding losing bags will likely want to exit their market when their position reaches break-even. However, if the asset reaches its all-time high (ATH), there aren't any sellers left who are waiting to exit at break-even. This is why some refers to earth breaches as blue sky breakout, as there aren't necessarily any obvious resistance areas ahead. Earth breaches are also often accomplished by a spike in trading volume. Traders may also jump on the opportunity with market orders to make a quick profit and sell at a higher price. Parabolic moves can often end up in very sharp price drops, as many investors rush to exit once they realize the uptrend may be coming to an end. Check out the price drop often after Bitcoin's parabolic move to 20,000 in December 2017. All-time low. The opposite of ETH, the all-time low (ATL) is the lowest price of an asset. For example, the all-time low of BNB was 0.5 USDT on BNB USD market pair on the first day of trading. Breaking an all-time low on an asset can lead to similar effect as when breaking the all-time high, but in the opposite direction. Many stop orders may trigger when the previous all-time low is breached, leading to a sharp move down. Since there is no price history below the previous all-time low, the market value can just keep going down, drifting lower and lower, since there aren't necessarily logical point for it to stop buying during such times in very risky. DYOR, do your own research. When it comes to the financial market, DYOR is a term closely related to fundamental analysis. It means that investors should do their own research into their investment and not rely on others to do it for them. Don't trust, verify in a common used phrase in cryptocurrency markets with a similar meaning. The most successful investors will do their own research and come to their own conclusion. As such, anyone who want to be successful in the financial market will have to come up with their own unique trading strategy. This may also lead to disagreement between different investors, which is a completely natural part of investment and trading. And investors may be bullish on an asset while another may be bearish. Different opinions can accommodate for different strategies, and accessible traders and investors will have wildly different strategies. The main idea is that they all did their own research, came to their own conclusion, and made their own investment decision based on those conclusions. Due diligence, DD. Due diligence is somewhat related to DYOR. It refers to the investigation and care that a rational person or a business is expected to make before coming to an agreement with another party. When rational business entities came to an agreement, it's expected as that their due diligence on each other by any rational actor who want to ensure that there aren't any potential red flags with the deal. Otherwise, how could they compare the potential risk with the expected benefits? The same is true for investment. When investors are scouting for potential investment, they need to do their own due diligence on the project or to ensure that they can take into account all risk. Otherwise, they won't in the control of their investment decisions and may end up making the wrong choice. AML, anti-money laundering. Anti-money laundering refers to a number of regulation laws and procedures that aim to prevent criminals from disguising their illegally obtained money as legitimate income. The AML procedures make it much harder for criminals to launder their money clean by hiding it or disguising it as coming from legitimate sources. Know your customer. KYC. Stock exchanges and trading platforms have to comply with national and international guidelines. For example, the New York Stock Exchange and the Nasdaq have to comply with the regulations set by the United States government. Know your customer or know your client guideline ensure that the institution facilitating the trading of financial instruments verify their customers, identify why this is important. The main reason behind it to minimize the risk of money laundering. In addition, KYC regulations aren't only valid for participants of the financial industry. Many other segments also have to comply with these guidelines. KYC guidelines are generally a piece of much broader anti-money laundering policy. Cryptocurrency trading terms can seem a bit confusing at first, but now you know a good chunk of them, so you can feel more safu with abbreviation. Make sure to Dior or FAT or no badly FOMO into a coin that has reached Earth and keep hodling and building. Still eager to learn more about cryptocurrency trading? Check out my YouTube channel, subscribe, like and comment. Thank you.